All right, my clock shows 10 o'clock. I think we can get started here. Good morning, everybody. My name is Tyson Moore. I'm an accounting supervisor in the not-for-profit division here at DWD. I want to take the time to thank everyone for joining today's webinar. With us today is Susan Berghoff and Phil McKenzie, directors here at DWD, and our presenter, Carrie Minnick. Now, before we get started, I have a couple of housekeeping items to cover. For those who ask questions during today's webinar, please use Zoom's question and answer feature. You should find that in the toolbar at the bottom of your screen. We will be answering questions periodically throughout the presentation. Also, Carrie's slides will be emailed to everyone attending today's webinar, along with being posted to our website after the presentation is finished. I think that's everything I need to cover. I'll now turn the floor over to Carrie to start today's webinar.
Thanks, Tyson. And again, I just want to welcome everyone today to coming to our webinar. Before we get started, just wanted to kind of give you a brief overview as far as what we're going to be talking about today. We're really going to be talking about more of the theory behind the chart of accounts versus specifics related to different accounting software, because a lot of different organizations use different accounting software, whether it be QuickBooks or MIP. And so we're not going to get into the specifics of the accounting software. So if you have questions about that after the webinar, feel free to contact any of us and we can work with you on your specific questions related to your specific accounting software. So let's get started. So in order to talk about the chart of accounts, we really need to understand what it is. So basic level, it's a listing of all of your accounts. It's an organizational structure for all financial information. All of your financial information starts with your chart of accounts. It's divided into different categories of different activities based on your organization. And it's really the foundation for your financial reporting. And that's why it is so important. But it's also the story you're telling about your organization. So that's why it's so important to make sure that it is set up correctly. I'm sure you've seen this image out on the internet. I know I've seen it several times, and I think it gives a really good picture of what your chart of accounts, your financial information is doing. So we are starting with a bunch of different data, a bunch of different transactions that happen every day in your organization. It's just a big pile of Lego blocks. Well, then we need to sort it and arrange it. And while we're arranging it, we're putting it into those different chart of accounts where it needs to go. And then we're going to present it into these financial statements and tell a story about what our organization is doing. So I just thought it was kind of neat to look at it from this way. All of your financial data, all of your transactions that's happening, putting it into your chart of account to organize it, presenting it to the financial statements, in the financial statements to tell your organization's story. So in order to figure out what accounts we should have in our chart of accounts, we really need to understand what makes up our organization, because organization A is probably not going to have the same listing of chart of accounts as organization B because they do different things. So when we think about this, we need to look at what programs we have, what departments do we have? Are we in more than one location? What kind of activities do we have? Do we get grants? Are those grants from the government entities? Are they from foundations? And what requirements do they have? So all of these together are all going to have different types of revenues and expenses, different types of transactions that we are going to have to record and report back on. In addition, nonprofits have to account for not only those different programs, locations, grants, but also funds, projects back to multiple stakeholders. So it's not just reporting to the owner of the business as in a for-profit. So in a nonprofit, we have management that we have to report back to so that they can manage the daily operations, make daily decisions. The board of directors to make decisions on the overall organization itself. Funders, they want your financial reporting to determine if the funds were spent properly, or if maybe they're considering whether they're going to give you additional funding in the future, and they want to see where you're at financially. Government entities, if you get money from state, local, or federal government, They are probably going to require some kind of reporting back. I know in the state of Indiana, they may require an audit based on government funds received. And then also the IRS. So you don't necessarily report or give the IRS a copy of your financials, but the information from your financials is reported on the 990. So we want to make sure that that information being reported to the IRS, which is available for anyone to look at because the 990 is a public document, is reported properly. So it's important to evaluate, well, all of these users of financial statements, when they're looking at your financial statements, what they're doing is evaluating your programs, your operations, your efficiency, maybe some compliance requirements. And as you can see, we have both internal users and external users to deal with. So what they're getting is going to be different based on who they are and the purpose of the financial reporting. Not only do we have to report to many different users, the reports that we're going to provide are going to look different. It's not going to be one trial balance, one P&L that we are going to report and give to every user, and that's going to suffice what they want. We have board reports that include monthly financials. There's probably some different reports we look at when we do the budget process. Our annual report, if you issue an annual report, is going to have financial information. It's probably only going to include pieces of your financials. You might provide some information about your financials on your website so the public can see where your funding is coming from and what you're doing it. Again, Form 990, if you have an audit or a review at the end of the year, that's going to be require you to provide some financial reporting. And then also in your strategic plan, part of that strategic planning process should also include looking at your financials and incorporating those financials into the plan. So more than likely, each one of these is not going to include the same information. Each is going to need something different. So how are we going to determine how to set up our financial reporting to meet everyone's needs so we don't have to create 8 different reports at the end of every month or at the end of each reporting cycle to get everybody what they need? So first, we need to determine the goals of the financial reporting. So what are those individuals that are reading the financial statements? What do they want to know? And so how can we set up our financial statements to be efficient in giving this information? So obviously, you know, overall, our goals are accurate. So we want our financial reports to be accurate. We don't want to include a bunch of estimates or unknown amounts. We want them to be accurate. We want them to be provided timely to the board and to those who are requesting those statements. If you are not receiving financial statements timely, then that really impacts the decisions that management, the board, and others that are looking at your financial statements are making. So that's really important, is to make sure that the information is received timely. You also want to make sure that it's not overly complicated, that it's easy to read, so that your financial reports, they provide information on your financials, what the organization is doing. However, we want to make sure that someone, maybe that's not a CPA, maybe that's someone that doesn't have a financial background, is able to read these numbers and understand what the organization is doing. They also need to be informative. And then finally, to meet the needs of the individual users. So again, looking at the most basic level of chart of accounts, it's divided up into 5 different categories. So we have assets, liabilities, and net assets. So these first 3 groups make up the statement of financial position, or in the for-profit world, the balance sheet. And then the other 2 are income and expenses. And these 2 categories make up the statement of activities, or what's called the income statement in the for-profit world. So these 5 categories really provide the basis for all of your financial statements. Again, diving into a little bit deeper what these 5 categories are: your assets are what you own, liabilities are what you owe others, Net assets are what you are worth. So on your balance sheet, you have the assets equals liabilities plus net assets. If this equation does not work, then there is something wrong. You have, there's a transaction that has been entered incorrectly. The other two, income is what you receive in, so the money coming in, and then expenses is what you spend out. So income less expenses is going to equal your increase or decrease in net assets, or your net income or net loss if you're comparing it to the for-profit world. So let's take a little bit deeper look into each of these categories. So assets. This obviously is not an all-inclusive list of all assets that you could have. However, these are probably the most common ones that you will have. So cash, obviously your bank accounts, receivables, what people owe you, inventory, those items that you have on hand to sell, prepaid amounts that you have paid currently for to be used in a future period, investments, so that's going to be, you know, your stocks, your bonds, maybe your investment at the community foundation, and then fixed assets. So that's your land, buildings, equipment, those assets that you've purchased that have a life over a year and are being capitalized and depreciated over that life. So as we look at our assets, so when we're trying to determine what accounts we should set up for our chart of accounts, and we're just focused on assets right now, here are some tips. First of all, one bank account equals one general ledger account. So that we don't want to have multiple bank accounts going to one general ledger account or multiple general ledger accounts going into one bank account. It is going to make it tremendously more difficult to reconcile your monthly bank statements if you have multiple bank accounts going to multiple GL accounts. So one bank account equals one GL account. Make sure all of your bank accounts, all of your assets are included on your chart of accounts. Sometimes I've seen where people may have a PayPal account to collect online deposits, which is perfectly fine. But that PayPal account is considered an asset of your organization. So make sure that that is listed on your chart of account, and all the activity that goes through that PayPal account is recorded on your organization's chart of account. Because again, these assets are things that you own, and that is very important to show that when people look at your financial statements to see what the organization owns. As far as receivables, there's two major types of receivables. So we have contributions or grants receivables, and then we have accounts receivable. So accounts receivable are going to be those trade receivables where you've provided some type of service, and in exchange, you're going to be paid for that service. So it's an exchange transaction. It's more of like a for-profit type of transaction where you've provided a service or sold an item, and then you're going to be paid for that. Contributions, pledges receivable, grants receivable, those are more of, I promise to give you some money in the future because I really like what your organization is doing and I want to support that work, and I'm not going to get anything in return for that contribution. So it's really important to separate those two types of receivables on your chart of accounts. So I recommend not having just one receivable account, but to have two, accounts receivable and contributions receivable, because they're derived from two different types of revenue transactions. So keep those separate on your chart of accounts. Same way with bank accounts, investment accounts, really one general ledger account equals one investment account for the same reason. It's much easier to reconcile those monthly or quarterly if you can just reconcile between one investment account and one general ledger account. And then finally, fixed assets. You can have one, fixed asset account, maybe if you don't have a lot of different fixed assets. However, it's probably best to separate those fixed assets by type. So land, which isn't depreciated, should probably be separated from those assets that are depreciated. Buildings, equipment, just separating the different types of assets that you can have, so that way you can clearly see what the organization owns. So at the most basic level, when you're determining what account should be included in your chart of accounts, how many different accounts you should have, again, you're going to kind of think forward as to who's going to be looking at the chart of accounts, and what are these reports going to be used for? Well, most nonprofit organizations have to file Form 990 with the IRS at the end of the year. So the IRS wants to know what kind of assets you have. So if you don't have any other kind of reporting, so just at the most basic level, you have to file a Form 990 at the end of the year. This is what the IRS asks. This is the full version of the Form 990. So if you have less than $200,000 in gross receipts, then you can file a different version of this form. But this is kind of something to strive for, I guess, when you're looking at assets on how to record those on your books, setting up the different chart of accounts. The IRS wants to know your cash, non-interest versus savings. You can see here on lines 3 and 4, they've separated out those contributions receivable, grants receivables from accounts receivable, inventory, prepaid, and then the different types of investments. So again, if you're looking at some place to start where you should look to determine what kind of assets you should include in your chart of accounts, this is a really good place, because you are going to have to take your information, your financial information, and put it on this form at the end of the year. So it's probably easier to create those to match up with this now rather than later. So here's an example of a very simple chart of accounts, again, just for the asset section. Again, this is it's not an all-inclusive list that includes all the different types of assets, but at the most basic level, this will probably work. Please note that these do have account numbers. Please use account numbers in your chart of accounts. I know some accounting softwares require you to use account numbers, but others do not. It's much easier to enter transactions, maintain the activity if you're using account numbers. For example, you could have 2 interest accounts, an interest income and an interest expense account. And it's much easier to determine which account that is being used if you just call it interest, if you put account numbers in front of it. Also, when you're numbering your accounts, use a logical numbering system, and you'll see the assets all start with 1. So you don't necessarily have to do this, but this is best practices. Assets usually start with 1. This sample has 4 digits. You could use 5 digits, you could use 3 digits. Doesn't matter, it's up to you. You'll see here that it doesn't go 1001, 1002, 1003. We've left some space in between, so we've counted by tens. That way, if we have a new bank account that we need to add, we could add it as account 1025. Because when you're organizing your chart of accounts, it's best to put similar type of accounts together. So that way, if we do have a new bank account to add, we can just slide it in there with all of the other bank accounts, as opposed to putting it at the end with the fixed assets. So again, make sure you use numbering, logical, order, spread out. You'll note here, we have a separate checking account, separate savings account. We have the 2 different types of receivables. For the investment, I've separated them out between XXX, YYY investment. So maybe you have like a PNC investment and a Schwab investment or something like that. So I would clearly label those just so you can separate those 2. We have the beneficial interest in the community foundations, which is a separate investment. And then we've detailed out our fixed assets between land, building, equipment, vehicles. We've put all of the accumulated depreciation into one account. If you'd like to separate those out in between building, equipment, vehicles, you certainly can. But again, I would think, what does the end user want to see? Does anyone who's looking at your financial statements at the end of the day want to see accumulated depreciation broken out by building, equipment, and vehicles? If they don't, put it all into one accumulated depreciation account. It will be much easier when you're doing your journal entries. So again, this is just a very simple chart of accounts that you could use for the asset section. Next, let's talk about liabilities. So these are amounts that you owe to other people. So most commonly accounts payable. If you have a credit card payable, accrued payroll for earnings that have, or amounts that have been earned but not paid, payroll withholdings, lines of credit, loans, deferred revenue. Again, not an all-inclusive list, but these are some of the main categories of liabilities. So some recommendations when you're setting up your chart of accounts for liabilities. Again, same with bank accounts and investments. For loans, I would use one loan equals one general ledger account. Again, just it makes it much easier to track payments, reconciling that at the end of the month to what the bank is saying if you use one loan account to one general ledger account. I would encourage you to use a credit card payable account. I know this is very common in QuickBooks. That by using a credit card payable account, you are able to add the transaction when the credit card is actually used into the software. So if I go to Walmart, buy some program supplies today, I use the credit card, that charge is going to go into the accounting software today when the expense was actually incurred. Then at the end of the month, when the credit card statement is received, then we can reconcile that credit card statement to the actual credit card payable balance that's in the software, just like we would any other bank account. So again, just makes it a little bit more cleaner, makes it better for transactions to be reported when they're actually incurred instead of at the end of the month when the bank statement or when the credit card statement is received. And then finally, separate different types of liabilities. So we separated, the accounts payable from the payroll liabilities. Just again, thinking about at the end of the day, when someone looks at your financial statements, when they're looking at liabilities, the amount that you owe other people, what do they want to see? And then breaking down your accounts by that. So again, the IRS, they want to know about your liabilities. So if you have no other reporting to do, you will likely have to report to the IRS on your 990. So this is the liability section of the 990. So if you're thinking of a good place to start looking at what kind of accounts you should include, this might be a good place to start. So we have our accounts payable and accrued expenses, grants payable, deferred revenue, mortgages. They tend to lump a few more liabilities together than I would actually on my chart of accounts. I would probably break them out a little bit more. But again, when you're thinking about the end user, this is what the IRS is going to want you to report. So when we look at a sample section chart of account for liabilities, this is what we have. Again, not all inclusive list, but some main categories to get started with. You'll see that the liability sections all begin with 2. The assets started with 1. So that way, when we're looking at our chart of accounts, we can clearly see that, okay, this account starts with a 1. We know that's an asset account. This account starts with a 2. We know that's a liability account. And again, you'll notice the consistent use of numbering, spreading them out. So that way, if we have additional accounts payable or different notes, loans to include, we can just slide those into the area where they go. Note payable XXX, again, I would put the bank name in there, PNC or First Source or whoever you use, so that way you can clearly see who that is owed to. The third section we have is net assets. So net assets is not usually, doesn't have as much chart of accounts listings as some of the other categories. There's more that goes on with net assets, but as far as just chart of accounts, it's really broken down into 3 sections. We have net assets without donor restrictions, net assets with donor restrictions, and board designated net assets. So first, let's make sure we understand what these 3 sections are. Net assets without donor restrictions, that represents money that's given to your organization that you can use for whatever you want. So I'm going to give you $10,000. I really like your organization. Here is $10,000 that you can use for whatever you'd like. Net assets with donor restrictions is where me as the donor, I am going to say, here's $10,000, but I want you to use this for program A. So you can only use that for program A. The donor has put a restriction on it. Board designated net assets are monies that have been received and they are unrestricted by the donor. So that's that first $10,000 that I gave you. You can use it for whatever you want. But the board could say, we're going to set $5,000 of this aside because we need to purchase some equipment next year. So we're going to set this aside. So the board has designated this money to be used for a certain purpose. Only donors can restrict net assets. When boards set something aside, when there's an internal restriction, it's called a designation, and they can only designate monies that have not been restricted by donors. So some tips on net assets. Do not have a restricted account for each donor. So if you get money from all different types of donors, all different foundations, and they're all restricting it for a specific purpose, and you start having net assets, restricted from Bollinger, from Lutheran, from all these different foundations, you are going to have way too many accounts in your chart of accounts. So we don't want to have a restricted account for each donor. Many organizations will only have one net asset account, and everything gets thrown in there, which is fine, but you still have to track restrictions. So that's one thing about being a nonprofit. It's very important that you track the donor restricted money, so that way so you can prove that it is being used for what the donor said it's supposed to be used for. So there's different ways in accounting software to do that. But if you're not going to do it within your accounting software, that's fine. Just know that you're going to have to track it somehow in Excel, or some other spreadsheet, or somehow outside of your accounting software. So again, the IRS wants to know about your net assets. So at the minimum, really they just ask for line 27 and 28, which applies to most nonprofit organizations, is net assets without donor restrictions and net assets with donor restrictions. And again, you can see a sample chart of accounts for net assets. Again, you'll notice that they all have account numbers, and net assets start with 3. And so we've divided them between net assets without donor restrictions. So again, that money that you can be used for anything that you like. Net assets with donor restrictions. We've included one called net assets with donor restrictions PERM. So this would be those net assets that are restricted indefinitely. So that would be like your endowments, the initial amount that was put into your endowment. So sometimes it's nice to track that separately. And so that's what this line item is doing. And then board designated net assets. The fourth section is revenue. So nonprofits are unique in that they get revenue from a lot of different sources. There's also earned income and then contributed income. So again, contributions and grants, that is where someone gives you money, they don't expect anything in return, versus earned revenue where you are going to have to do something to get paid. We also have investment income, especially if we have an endowment or investments, and then other types of revenue. So some recommendations on setting up your chart of accounts related to revenue. Please do not have a revenue account for each grant. Again, you are going to have way too many accounts, and sometimes your accounting software limits how many accounts you can have in your chart of accounts. Also, if you add a new revenue account for each new grant you get, that might just be a one-time grant. You might just only get that grant this year. So I would not recommend having a new revenue account for each grant or each new donor. I would encourage you to separate government funding from non-government. A lot of times with the government funding, we need to know where the money comes from and how to account for it. So it's pretty important to be able to keep that separate. There's also additional audit requirements and reporting that need to be done if you're over a certain dollar amount of government spending. So it's really important to make sure that you maintain that and know where you're at during the year. And then finally, on both revenue and expenses, and we'll get into this a little bit more as we go, but utilize funds and cost centers. So, the funds are going to be different fund segments, whether it be unrestricted, restricted, permanently restricted. Cost centers identify the functional area, department, grant, funding source, program. So this different, depending on what accounting software you have, you can do this differently. So for example, QuickBooks, they use classes and jobs to utilize this. MIP uses program codes and restriction codes. So instead of creating multiple accounts, GL accounts, we're going to utilize these classes, these funds, these program codes to better track our revenues and expenses. And again, we'll talk about that in a little bit more in a few minutes. So again, the IRS, they want to know about your revenue. So at the minimum, this is probably what you should be tracking if you don't have any other kind of reporting. So they have it divided between contributions, so that money that is contributed, the contributions and grants, program service revenue, so that's that earned revenue, and then other revenue, so whether it's sales from assets or rent income or just other miscellaneous revenue. So again, if you're looking for a place to start, thinking about the end game here, this is what you're going to have to report. So you might want to set up your chart of accounts based on these different lines that the IRS requires you to report on. So again, looking at a sample chart of accounts for just the revenue section, notice again, we use account numbers, revenues, these are starting with 4. We separated contributions and in-kind contributions. So beginning with all of you June 30 year ends, there are some additional disclosure requirements for in-kind contributions. So we can no longer put cash contributions and in-kind contributions on one line on your audited financial statements. So it's important to track those. So again, because there was a change in accounting standards, we may have to change our chart of accounts and how we're tracking things. Thinking about the end user, we're going to have to separate out those in-kind contributions. So if you don't have an in-kind contributions account currently, and you get donated items, services, facility use, you might want to create one of those accounts. So that way you can more easily track the in-kind contributions. Again, government grants is split out so we can easily see what we've gotten from the government, our program service fees, membership fees, special events. So that's your, your annual auction, dinner and an auction, your golf outing, those type of events. On your 990, the IRS asks for you to split that revenue in between two types, the contributed revenue and then the fees, the exchange transactions. So for example, I'm going to spend $200 to go to your dinner and an auction. Of that $200, $50 is going to cover my meal and $150 is considered a contribution. So that $50 is the exchange transaction, that's the fee, and then the $150 is the contributions. Now, some organizations will track this through their accounting software as it happens, as the money is coming in, which is fine. It's easier to get those numbers than for the 990 when it's time for that. Others will just put the total $200 into one account, which is fine, but you're going to have to track that somehow. So just remember that that's one thing that you have to track. So how are you going to do that if you're not going to do it within your accounting system? And then we have interest, gains and losses, and other revenue. The final section are the expenses. So here's where we can get kind of crazy with our different types of accounts that we have. In general, expenses though are kind of divided between personnel, so your salaries and wages, direct assistance that you're giving to program participants, contracted services, occupancy, office, travel, and other. So some pointers when you're setting up your chart of accounts or evaluating your current chart of accounts for expenses. One thing we don't want to have is we don't want to have a salary account for every single employee. So usually there is one salary account. However, again, based on what your end user wants to see, you might have more than that, but please, probably not reasonable to set up a salary account expense for each employee. Do not have an expense account for each vendor. More than likely, you will run out of accounts if you do this, and more than likely, no one wants to see how much you paid to each separate vendor every month. group similar type of accounts together. So, those personnel costs, the salaries, payroll, employee benefits, we probably want to kind of put all of those together in one section. The occupancy, the rent, utilities, telephone, we kind of want to put all those together. So that way we're kind of keeping it clean, consistent, easy to read. Do not create separate accounts for small amounts, especially if it is only a one-time expenditure. Again, we want to limit the number of accounts that we have. It's much easier if we don't have a multitude of expense accounts for every single type of expense that we have. As I noted before, with the income, using the different functions, programs, classes, we want to use the same type of thing for expenses. Utilizing the funds in the cost centers. So when we're putting in the chart of accounts, the GL accounts for expenses, we want to base that on natural classifications. So that means what the expenses for, like salaries, supplies, telephone, rent, those are natural classifications, as opposed to program X supplies, program Y supplies. So just looking at the GL account, the chart of accounts, when you're setting up the different accounts, we want to use the natural classifications, and then we want to utilize funds, classes, programs to get down to that other information that we're going to need to report. So again, the IRS wants to know about your expenses. And so this is the type of expense categories that they have asked for. So when you're looking to see what kind of expense accounts to create, you might want to start with the 990, the different types that they have: salaries, payroll, taxes, contracted services, advertising. Here is a sample chart of accounts for expenses. There's no requirement as to how many expense accounts you have to have or that you're allowed to have, but you really want to make sure that you're separating expenses that aren't the same or that aren't that don't go together. For example, you wouldn't want to put salaries and utilities in one account. Now you might want to put rent and utilities into one account and call it occupancy. Again, it depends on what the end user wants to see. So if they just want to see all of the occupancy expenses together, this is how much it costs for the building, the use of the building, that's great. If they want to see, maybe we spend a lot on utilities. We have a very big building. We have a bad HVAC system. Utilities has been really high. Maybe we want to separate out rent and utilities. Again, we need to think about what the end user wants to see. You can see that we put those salaries and related expenses together: salaries, payroll, employee benefits, accounting and legal, those kind of fees go together. You'll notice that we continue the use of the numbering, expenses starting with 5, also allowing some additional room in between. So if we do have to add new expenses, we can easily put those in. So one thing I want to talk about when we talk about expenses is allocating expenses. So we talked about the natural classification: salaries, rent, supplies. Nonprofits are also required to allocate expenses between function. There's 3 main functions: program, management in general, and fundraising. Program are expenses that directly or indirectly relate to providing program services. Management in general are expenses related to the overall operations of the organization. So management in general expenses, it doesn't matter what kind of programming you're doing, because you are a business in operation, you have these expenses. So for example, bank fees. You have bank fees, doesn't matter what kind of programming you're doing, this management in general. Your audit cost, doesn't matter what kind of programming you're doing, that's just the price of operating a nonprofit and having to have an audit done. Fundraising are those expenses that are relate to inducing people to give money to your organization. So those expenses related to putting on your annual fundraising event. So first of all, GAAP, if you have an audit or a review done, you're going to have to allocate your by function. The 990 requires you to allocate your expenses by function. Those allocations are not the same as allocating expenses for grants. The way you allocate your expenses for grants, specifically government grants, is different. So you just need to know that there is a difference, and just because a grant for a specific program allows you to allocate some of the audit cost or some of the admin fee to that, that is not going to be considered program for what we're talking about here for accounting. So just be aware that of the requirement and that there is a difference. Not only do nonprofits have to allocate expenses between these three functions, you also have to stay in your audited financial statements in the notes how that allocation is being done. So again, we must have a reasonable and consistent basis for allocating these expenses. So some of those reasonable bases are on the screen here. Well, first of all, a direct expense means that it's not allocated between the three functions. It's specifically identified with a certain function. So for example, let's say you have an employee who is in charge of program A. That's all they do, is they only work on program A. So their salary is going to be directly expensed to program A. They don't touch any of the other functions. Expenses that do cross other functions, utilities, telephone, supplies, depreciation, they have to be allocated in a reasonable basis. So what is a reasonable basis? Well, time and effort. So this is relates normally to salaries and related expenses. What is the number of hours or time spent by each employee on each function? And then you would allocate that percentage across management, general, programming, and fundraising. For those expenses that are related to the building, like repairs and maintenance, rent, utilities, you could allocate those expenses by square footage. You could also use full-time equivalents or units of service. So there are different bases that can be used to allocate expenses. It just needs to be reasonable and it needs to be consistently applied. Allocating expenses based on revenue is not a reasonable allocation method. We need to allocate resources that are used in these different functions, program, management in general, and fundraising. And the standards have come out and said that the allocation of expenses to program, management, general, and fundraising based on revenues is not a reasonable manner. So we need to look at the resources that are being put in, time and effort, square footage, that type of thing, and make an allocation. Your allocation may change. So if you add new programming, if you add new people, if you lose people, if you add a second location, these are all things that could cause a change in your expense allocation. So when these things happen, you want to reevaluate your allocation basis to make sure that it's still reasonable for the circumstances. Sometimes accounting software, depending on what accounting software you have, you can actually set up an allocation method for different accounts, and then the software will automatically allocate those expenses throughout the year. Or some people wait till the end of the year to allocate those expenses for the 990 for the audit. It's up to you. There are different ways to do it. Just know that you are required to do that as a nonprofit. Also related to expenses, when I was talking before about using natural classifications and then utilizing the classes, the funds, this is kind of gives you a picture of what I was talking about. So for example, this slide here, we have salaries. So we have 3 salary accounts set up in our chart of accounts, one for program, one for management in general, and one for fundraising. So as the reader of the financial statements, when I look at this, that's great. I can see we spent $50,000 on programming, $25,000 on management general, and $10,000 in fundraising. But there's nothing on here that tells me how much in total we spent for salaries. So again, I have the 3 different totals and I have to add that in my head. And we want to make it as easy as possible for the reader of our financial statements to get the information that they need to get. So instead of doing it vertically, how about we do it horizontally? So instead of 3 salary accounts, we have 1 salaries account, 5,000 salaries, but we're utilizing the classes or the programs to allocate that between program management and general and fundraising. So now when I look at this, I can clearly see the total amount we've spent in salaries, payroll taxes and employee benefits, but then I can also clearly see the amount we've spent on each of these functions. So again, when you're looking at the two, which is easier to read and which is going to give your reader better information about the organization? I would have to tend to go towards the horizontal just because I can see both total salaries and total spent in each of those different functions versus having 3 different salaries accounts and having to add those up. So when we're talking about the chart of accounts, don't forget about the budget. So your budget should be based on your chart of accounts. So when you have a budget, we really want the budgeted items to line up with the same accounts in our chart of accounts, because if they don't, it's going to be much harder to compare budget to actual throughout the year. So again, if you have salaries, account 5,000, then you should have a salaries on your budget so you can clearly match those two up. If you have your budget set up by your chart of accounts, then you can put the budget into the accounting software, and then the accounting software can create those reports for you monthly. So it will take you less time. And then you can just push a button and get that report out so you can see budget to actual. Just don't want to forget about the budget when we're doing this. So we talked a lot about chart of accounts and kind of more of, if you're creating a chart of accounts from scratch, but your chart of accounts should really evolve with your organization. So when you started, your organization was probably much smaller. Maybe you've changed your programs, maybe you've grown. So maybe you've gotten new funding sources, maybe you're now getting government money. So when was the last time that you actually went in and evaluated your chart of accounts? Eliminating those chart of accounts that maybe aren't used anymore, or creating new ones that better reflect what your organization is doing. Now, when you do, or if you do go in to revamp your chart of accounts, just remember a few things. Don't reuse account numbers, because if you start reusing account numbers and then you start running historical reports compared to current year reports, they're probably going to be representing 2 different things. So maybe in the past, this account number was used to represent rent. Well, we don't pay rent anymore, but we, have our own building, but we've now used this account for supplies. So if we reuse the same account number, now we're comparing rent with supplies, and we don't want to do that. So just make sure that you don't reuse account numbers. If you change your chart of accounts, it will probably impact prior periods, which is kind of what we just talked about. And then also, if you decide to change your chart of accounts, do it at the beginning of your accounting period. Don't do it in the middle of the year. That's going to create issues. And also, please tell your auditor or outside accountants before you do it. They will be much happier if you tell them before and warn them that you're going to do this, as opposed to getting a new chart of accounts at the end of the year when it's time to do the audit. So I just want to leave you with a few recommendations. As far as if you're a super new organization that you need to create a new chart of accounts, or if you've been around for a while and it's time to look at your chart of accounts and say, okay, are these chart of accounts really giving us what we need to know? Align your chart of accounts with your organizational structure. And again, that's looking at what programs, what funds, what locations you have, and really utilizing setting up your accounting software to utilize those different functions that it has. Keep the end user in mind. If the end user doesn't need to know how much telephone expense I pay, then why have a separate telephone expense? Put it in with utilities. What do we have to report on? And by setting it up early now, then that's going to save us time at the end when we're creating those reports. Create only what you need. If you don't have any loans don't create a loan account. If you don't have any investments, don't create an investment account right now, because that's just going to muddy up your chart of accounts. It may also create questions to the reader if they're like, well, why do we have this account? Do we have an investment account? Only create with what you need. And again, that's why we use different account numbers and separated them out. So that way, if we do have an investment account later on, we can slide that account in when we need it. Don't get too specific. So it's kind of a balancing act between creating only what you need, having a good number of accounts, but not getting too specific and having an account for every transaction. And then leverage your accounting system. So the accounting softwares now, they can do a lot. And just utilizing them to not only create the chart of accounts, but also the programs, the funds, and that type of thing, and having those different reports set up. So that way, when you need to run a report for a grant, or you need to run a report for the 990, or there's special reports that the board wants to see each month. Look to see what your accounting software can do and if it can create those accounts, because that will save you a lot of time and energy from, exporting it to Excel, manipulating it, and possibly making mistakes because you're manipulating the numbers. So leverage your accounting system when you're creating those different types of reports. I don't know if there's any other questions at this point. If there is, I think we've probably looks like we've addressed those, but if not, I think I'll turn it over to Tyson to wrap us up.
Yes, just as a reminder, this session was recorded, so the slides and video will be available on our DWD website in the not-for-profit section. A link to this section will also be emailed out to everyone who attended today. While you're on our website, please visit the not-for-profit webinar page where you can register for our next webinar. It'll take place November 9th. It's titled "What It Means to Be Tax Exempt." With that being said, I want to thank everyone for joining us this morning. Have a great rest of your day.